Hey, Bowtie Nation. Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern, every Monday morning. Get you ready for the week. Stocks I'm watching, economic news to highlight. And I started writing up this week's video Friday afternoon after the Wall Street Journal reported news that California's state regulator put a hold on a critical deal for Medical Properties Trust, ticker MPW, sending that stock plunging as much as 15% during the midday. It wasn't until after the market closed that MPW was able to publish a response to the article, and clues came in that the article was a planned attack by short sellers. Either way, whether it's California or the short sellers, someone is trying to kill MPW. The only question is, will they succeed? I'm going to detail the facts there, whether it's a good investment, what I'm doing about it, and stick around after that. We'll get to our Monday market update, stocks to watch, and the economic news that could guide the week. First, though, more important than finding the stocks to buy is how you invest and having a customized investing plan that fits your needs. That's why I put together this quick win 5-minute guide to making your own investing plan. Click through the link below and you'll get an easy 5-minute guide to making a plan that fits your needs. It's totally free, just something I wanted to do for all you out there in the community. So look for the link below and get your free plan. Back to our main topic, though, and we can see here shares of MPW plunged as much as 15% on Friday before recovering some of that lost ground, but are still down 40% on this year to date and a whopping 70% from the December 2021 peak. Investors sold on that news reported by the Wall Street Journal that the California Department of Managed Healthcare has put a hold on the company's deal with one of its largest tenants, Prospect Medical, to receive equity in Prospect's managed care business instead of cash payment for $573 million in loans and some unpaid rent. Now, a termination of that deal would put Prospect's future further in doubt and could mean that MPW is forced to further mark down some of those assumptions that it has for rent and debt collection from that company. There is more here than's being reported. We see here on the statistics tab here in Yahoo Finance, we scroll down to the share statistics and we see that nearly a third, 29% of the company's shares are borrowed and sold by short sellers, betting on that further drop in the price. MPW did publish a response late Friday that the Wall Street Journal article was planned to strike fear in the market and push a drop in those shares, and that the regulatory hold is nothing new and actually fully expected. And so, going back to read through this Wall Street Journal article, I saw the depth of the negative data and really the information goes well beyond what's normally reported and just smacks of help from a short seller analyst. That's not to say that there aren't some major problems with MPW, and whether the article was a well placed attack to make some short sellers rich or not. It shouldn't hide the fact that investors do need to look at this whole picture. I want to detail those problems, why MPW actually rallied 45% earlier on in the year, and why it's falling now. Full disclosure, I do own over 4,000 shares of MPW at a cost basis of about $8.90 after some options on it. I believe the dividend is very likely to be cut right now to preserve cash, but should still produce a good yield and a great total return on long-term price appreciation. Now, Medical Properties Trust is the largest hospital landlord in the United States with over 444 properties in 10 countries globally. That makes it a good play on the real estate for a part of the market that should continue to see strong demand as that aging population just pushes healthcare spending higher. The last 2 years has just been a perfect storm for real estate and the company. Higher interest rates smashed real estate valuations last year, with the broader real estate sector falling 27% on the year. Elective procedures and some of those higher margin surgeries were postponed during the pandemic, leading to a lot of losses by hospital tenants of the company. The nursing shortage, the demand for jobs in general in the industry have just pushed wages higher, and the reimbursement rates by the government just has not kept up with inflation. All this has put healthcare servicers in financial jeopardy and really is flowing down to those missed rents and debt payments to landowners like MPW. That brings us to the company's two largest tenants, okay, Prospect Medical and Steward. They've both been hit particularly hard by all this. MPW has progressively loaned the companies more money, extending those rent terms, and altogether propping up the hospital servicers. So, really, to avoid them filing bankruptcy and having to wipe out a lot of the company's debt and owed rent. We do see here, though, that shares of MPW did rally 45% from a May low through July on just stronger operating results across the hospital service industry. We are seeing some rebound in hospital services, in the facilities, and how they're managed, as well as just management of MPW, assuring us that funds from operations, that FFO measure, would be $1.60 per share this year, would more than cover the $1.16 per share in dividend payment. A dividend cut was put back on the table in recent quarterly earnings, just on lingering cash flow troubles, and the company does seem to be pulling those two tenants, Prospect and Steward, closer in instead of really hedging its risk against it, giving those companies more equity or taking more equity in those companies, extending more loans to those companies, rather than kind of trying to hedge its risk in the finances of those two companies. It's becoming clear that Prospect and Steward are near insolvent without MPW support, so it's really all on MPW at this point. Much of the crisis across healthcare is across the whole industry there, but also bad management at these two hospital companies. Oh, against that, MPW owns real estate, so that tangible property across the healthcare industry that has great value long term. So the ultimate question that investors need to be asking right now is one, can MPW support Prospect and Steward through to a recovery? And two, if either or both of those fail, can MPW survive? If the answer to either of these is yes, then the stock is a screaming buy right now. Even with a 50% dividend cut to protect that cash flow, the shares would still pay an 8% dividend yield and I believe have 85% upside to a $13 per share fair value. But then if the answer to both of those questions is no, then the stock is a value trap going to zero. Now, addressing that solvency issue for MPW specifically, we do see here on the cash flow statement with this in cash position, it has over $240 million in balance sheet cash and has addressed its debt maturities through 2024. So that's more than a year where it has no significant debt maturities to pay off. We expand this financing cash flow here. We also see that it pays over $700 million here, cash dividends paid, over $700 million a year in cash dividends. If it were to cut that, maybe even cut that by half, it would be saving an additional $350 million each year that it can help preserve those other two companies or its own business. So the company is already free cash flow positive without a dividend cut. I believe that dividend will be cut, protecting cash even further and put it into safe territory to provide the finances it needs to support tenants through a healthcare crisis. And understand, by supporting these tenants, it's not just giving them free cash; it is giving them, extending loan terms, extending unpaid rent, taking equity shares in the businesses. So if those businesses do finally turn around, that's just going to be higher returns for MPW as it collects on those equity shares. Reading through this Wall Street Journal article, it does try to paint Prospect and MPW as the bad guys here. It is very easy to see how this could have been written up by a short seller trying to attack the company and see those shares fall further. Several times here, it does accuse MPW of not disclosing the fact that regulators were putting this deal on hold or were likely to put this deal on hold. It further accuses MPW of playing a crucial role in private equity's push into healthcare businesses, right? So kind of selling out services to private equity firms. It also goes on to say that Prospect's hospital closures have created a maternity desert on the eastern side of Delaware, and it's really weird that this blaming publicly held companies for the government's inability to keep reimbursement rates up. Okay, that's why a lot of these hospital services and these hospitals are shutting down across rural communities. It's because the government has not been able to keep up those reimbursement rates, so those hospitals are just losing money hand over fist. Well, yeah, what do you expect them to do? That is really weird that the Wall Street Journal usually has a very conservative stance on business, very much free market stance on business, that in this article is blaming a publicly held company, a free market company, for pulling its services out of an unprofitable area. That, combined with just the depth and the detail of the negativity in this article, does lead me to believe that it had significant help in the reporting from, if not directly from a short seller, just from a short seller report. Basically, the journalist just reading through a short seller report and copy and pasting a lot of what it says. MPW did release a statement later Friday saying it engaged the article's author on the facts, but its information was then wholly disregarded, and Prospect was not even given time to comment. Okay, if you scroll down a little bit further here, it gives its response in outline form. Here, it says that it contends that the California notice is standard, expected, and just a non-controversial part of the approval process, and that it still fully expects to obtain that approval in due course. The company further contends that all disclosures have been made and the accounting is consistent with requirements. Again, full disclosure, I do own 4,250 shares of MPW. I think it's going to be a great investment as the hospital services industry continues to recover. There are a few lessons here I want to highlight for investors. I do believe the company is going to elect To preserve cash by cutting that dividend, there's no indication of how deep that dividend could be cut, but the yield could still be very attractive. They could cut this by 50%, still provide an 8% yield on those shares at the current price. I still believe that it's got a fair value of at least $13 a share, great long term demand in healthcare facilities, and it's the largest hospital servicer in the United States. If MPW were to fail, that would be a catastrophic crisis in healthcare for the United States. The first lesson, and this is something I talk about quite a bit on the channel, is you cannot have more than 5 or maybe at most 10% of your money in any single stock. Okay, folks, bad things happen even to good companies, and putting all your money into one stock is just a recipe for disaster. Lose your entire investment on a stock that's even 10% of your portfolio, and you can build back from that. It sucks, it hurts, but it's only 10% of your money. Keep buying a stock, though, all the way down, putting 20 or 30% of your money in it, and bankruptcy is just going to destroy your faith in stocks forever. Okay, I know this is a hard lesson to learn. It sucks if you already made the mistake. How do you think I came to make the rule? I've made the mistake before, and now I don't put any more than 5 or 7% of my money in any single stock, no matter how much I like it. The second lesson, though, do not get scared out of your investments, okay? Investors were loving shares of MPW when it rallied 45% last month to past $10 each, and I believe it will get there very soon and still provide that dividend that we all love. Okay, the plunge is again frustrating investors, and some are selling in despair. That is never the kind of emotion you want to use leading into your decisions because it's going to bring out those bottom feeders that are just preying on your distress to pick up those deals. Okay, I've shown why I think MPW is a great company, a solid long term stock. Do your own research as well and have the confidence in that long term decision. I want to transition here into some of the stocks I'm watching for this week. First up is Advanced Auto Parts, ticker AAP. It's going to be reporting its earnings on Wednesday following the company's tragic release in May with an 83% dividend cut. It saw the stock plunge 35% on the news. Their shares are now off their 2021 peak by 70%, but there is reason to believe that this could be a great buying opportunity. Management missteps have really hobbled this leader in auto parts, trailing its competitors, but the current CEO is set to step down by the end of the year. They're going to get new management in to turn this thing around. The average age of cars on the roads has increased from 10.3 years back in 2018 to 12.5 today, 12.5 years old. So the demand for those aftermarket parts is healthy. I bought the shares after that May plunge on the basis that if management cannot engineer a turnaround this year or very soon, the company could start attracting that activist and private equity investment. This is exactly the kind of company that private equity firms love to buy. Here we see on the cash flow statement for Advanced Auto Parts, it has a recognizable, a popular brand, and very strong cash flows, posting $296 million in free cash flow last year. Add to that the $285 million in savings from that dividend cut that had announced last quarter, and the company will have no trouble with cash generation. We can see here in some of the valuations, shares now trade for an enterprise value of just 0.72 times sales. Okay, that means a private investor could snap up the company, the debt and all the company, for less than the annual revenue generated. That's versus a multiple of over 5 times just last year. Earnings are still expected to fall versus last year and no growth in sales, but we could be right in the trough before a recovery. Next up here is Nvidia Corporation, ticker NVDA. It's also going to be reporting its earnings on Wednesday with investors really looking for another blowout quarter just to justify that boom in AI stocks. Not only will Nvidia's report be important for its own valuation, it's now trading at over 42 times on that price to sales basis, but also for the valuation of all those AI stocks that benefited from that bubble. It was NVIDIA's May report that forecast that giant revenue growth for that AI chip demand that really started inflating that AI bubble. And I'm sorry, but without another strong outlook, it could be NVIDIA that kills the rally as well. The company is clearly dominating the race in those high performance semiconductors, so and it's likely to be a great investment long term. I just worry that near term gains and investors that might panic and sell in that plunge. So if you're not in this stock for the long term, just consider taking some of your profits, protecting that downside. Further upside in the Q2 report is likely limited. So even if they do beat those earnings estimates, they provide a good quarter. The upside is probably likely limited from here. The downside could be much more painful. Copart Inc., ticker CPRT, is scheduled to split its shares 2-for-1 with an X date of Tuesday, 8/22. Now, that does mean you need to own the shares by the close of market on Monday to receive those new shares. The stock price is likely going to fall by about half after that split, meaning your overall investment value isn't going to change. But share splits have historically shown a good sign of strength for the company, and post split returns have been good. AMC Entertainment, ticker AMC, though, may be a different case on its scheduled reverse split of 1 for 10 shares with an ex date of this Thursday, 8/24. Now, investors in AMC will have a tenth the number of shares, but the share price should rise roughly tenfold again, so causing that total investment value to remain pretty much unchanged. Now, a reverse split is generally done to keep that stock above a $1 listing limit set by the exchanges. This isn't the case for AMC. Instead, it's doing it the split as a part of the plan to convert those preferred shares, the ticker APE shares, into common stock. Neither of these, though, I've been investing in the APE shares before that split announcement, rode it all the way up to $1.96. It's now up to $2.27. Neither of these really at a right price that I want to jump back in, but the opportunity may present itself later. Giving you that bigger picture idea with the sectorspiders.com sector tracker. Here we see over the last week, all 11 stock sectors did close more than 1% lower, with weakness really seen across both those higher risk groups and the rate sensitive names. So stocks in consumer discretionary and communication services did fall harder, as would be expected in a sell-off. It's interesting that tech stocks, technology here, which as of late have been a weakness in the market, held better than the overall market. We did see some key leadership in semiconductor names like NVIDIA, like Applied Materials, who's returned to positive returns and really helped support those tech stocks. If we go here to the year to date, we do see that 5 of the 11 stock sectors are now in the red for the year, while the selling pressure may not be completely over, we are starting to see some valuations come back. Of note here are stocks and consumer staples now down 2% and utilities down 10% for the year. Both of these sectors are facing pressure on those higher interest rates as just yield seeking investors sell their dividend stocks for those higher yielding bonds. But the sell off has opened up an opportunity for investors. If the economy does weaken and bring the overall market down with it, rates should come down a little as well. And those stocks in both of these sectors are going to return as those safe haven investments to protect your portfolio. The Fed's annual policy forum in Jackson Hole, Wyoming, does start this Thursday with Fed Chair Powell's speech on Friday. Now, the lead up to this has been part of the reason for that pullback, for the weakness in stocks lately. Last year's speech by Powell was sounded on an especially hawkish note, really saying higher rates for longer, and that pushed stocks to a 4% sell off. So I think investors may have anticipated that again, repeat this year, and sold stocks early. While inflation is still well above the Fed's long-term target, there are signs that pricing pressures are coming down. The economy, the jobs market is still holding up relatively well, so that hopes of a soft landing are helping the stocks in the bull market this year. So if Chair Powell comes through with and keeps to that story, a soft landing, inflation coming down, on hold for interest rates, that could spark a rebound, at least for the short term in stocks. Get your free customized investing plan with the link below. Or click on the video to the right for the 5 best stock screeners for dividends, trading, and more. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.